Under the impact of Trump's tariff policies, China's export shipping volume has taken a significant hit, dropping by 50%. According to the latest data from the shipping intelligence platform LineRetica, cargo shipments from China to the US fell by half in just 1 month, with Transpacific routes nearly coming to a halt. In response to this dramatic decline, shipping companies have been forced to suspend services. Shipping orders plummet. Data provides concrete evidence. A total of 80 voyages from China have been cancelled. Japan's Ocean Network Express has paused its planned May service resumption, and another route has cancelled its stop at Wilmington Port in the US. The Mediterranean Shipping Company has also cancelled 6 voyages, while the 3 largest shipping companies in Asia have also suspended new routes. The price of shipping on West Coast US routes has dropped nearly 65% from the peak earlier this year. Once bustling, China's major ports have transformed into ghost towns overnight. Cargo ships sit idle, containers piled up, and the docks are eerily quiet. A truck driver filming at Lucy Port captured this stark reality.
这兄弟们看一下这个今年有多难哦。
Look how tough this year is. Such a huge port at Lucy, and I'm the only truck here. Before, trucks would line up outside the port, and it was always busy and crowded inside.
Data released in mid-April 2025 revealed the extent of the situation. Booking volumes for 20-foot standard containers on China-US routes have dropped by 45% compared to the same period last year. This information comes from Vizion, a logistic company offering real-time container tracking data. The company monitors millions of shipping bookings daily, pulling data directly from shipping companies, ports, and cargo owners, providing first-hand information from the front lines. If that sounds alarming, the data from Flexport paints an even bleaker picture. This leading US logistic platform reported that in the 3 weeks following the implementation of the US tariff policy in early April, container bookings from China to the US plummeted by over 60%. The Wall Street Journal reported that the world's 5 largest container shipping giants have downsized their vessels, reducing large ships capable of carrying 18,000 20-foot containers to mid-sized ships with a capacity of just 14,500 TEUs. Even smaller shipping companies have cancelled routes, with 24 sailings from China to the US, West Coast being cut in May alone. As early as March and April, industry insiders were already circulating news on the sharp drop in shipping orders, with the decline even nearing 40% at one point. Even Hapag-Lloyd, a global shipping giant based in Germany, confirmed that at least 30% of their China-US routes ordered were cancelled. Handling over 12 million standard containers in 2024, Hapag-Lloyd is a major player on the Asia-North American routes with a full cargo booking system that gives them direct access to order trends and cancellations. The conclusion is clear. The collapse of orders on the China-US route is real and complete, causing an unprecedented lull across the entire Transpacific trade route. Empty containers stack up like walls. Ports turn into ghost towns. In the past, cargo ships on China-US routes arrived at the ports of Los Angeles and Long Beach like clockwork, with dozens of ships docking and unloading every day. Containers were neatly stacked and the area was filled with activity. But now everything has changed. The ships are gone, cargo isn't moving, and the ports have become deserted. While the Chinese government has remained silent on the issue, the scenes at the ports in late April tell the full story.
大家看一下现在的中国真实的外贸。
Let me show you what China's foreign trade situation really looks like right now. See that? All the cranes at the port have stopped working. They're all raised up. Not a single ship. Footage from Ningbo Port and Yantian Port is even more shocking.
China's major world-class ports are facing a build-up of empty containers.
上海洋山港的集装箱呢堆到了太仓去了。
At Shanghai's Yangshan port, containers are now piling up as far away as Taichung. At Ningbo Zhoushan port, the buildup of containers is unprecedented. Shenzhen's Yantian port now has containers stacked 7 levels high, which has drawn widespread attention because 7 levels is the maximum stacking height for empty containers. This is not an isolated issue at a few ports, but a widespread problem at ports along China's coast. Guangzhou, Shanghai, Ningbo, Yantian, and Suzhou all have been affected. Port of Los Angeles Executive Director Gene Soroka reported that container volumes arriving this week dropped by 30.4% compared to last week. The scheduled May sailings for some shipping lines have now been cancelled. He predicts that if the tariff war continues, cargo volumes could drop another 35% in June, causing the port to face unprecedented decline. At the Port of Los Angeles alone, 20 blank sailings are expected in May, meaning 20 ships that were originally scheduled to dock will now cancel their trips entirely. With fewer shipments, businesses are also facing difficulties. Due to fewer orders and a lack of businesses, companies no longer need as many workers. In regions like Jiangsu and Hunan, even temporary workers are no longer being hired. Electronic factories are no exception. A list of the top 10 electronics factories suspending hiring was surfaced, with companies like BYD, Changshuo, and Lingxing among those listed. At a toy factory in Yiwu, over 300 containers are piled up in the warehouse, and even freight forwarders are advising the factory not to ship. An export furniture factory had its goods packed, but the customer suddenly disappeared. No one answered the phone, and emails went unanswered. Eventually, it was discovered that the order had been transferred to Vietnam. No one seems to want Chinese products anymore.
带大家看看义乌商贸城外贸现状。
Let's take a look at the current situation of foreign trade here in Yiwu International Trade City. This is District 2 of the market. Normally, this district should have plenty of foot traffic. But even at this hour, just after 2 p.m., there aren't many people around. Foreign buyers are especially scarce.
Even shipping giants are feeling the strain. Major global carriers like Maersk, Hapag-Lloyd, Costco Shipping, and CMA CGM have pulled back from China-US routes. Maersk cancelled 12 routes, Mediterranean Shipping Company suspended 6 sailings, and Costco halted 8 fixed schedules. Some sailings were even leaving ports without cargo, just to maintain the appearance of the schedule system. A captain complained on social media, now running a trip across the Pacific requires detours through Vietnam, Thailand, and Malaysia, making it more complicated than delivering packages. Transpacific shipping rates are also on a steep decline. A year ago, a 40-foot container from Shanghai to Los Angeles cost $8,000. Now, even at $3,500, it's still going unclaimed. The collapse of trust, managing orders, and the shift of supply chains to other countries. Chinese manufacturing is no longer seen as a safe option for global buyers. In April 2025, the Trump administration reinstated and escalated tariffs on Chinese goods, with average rates for key categories soaring to 145%. The removal of the small package duty-free policy further devastated cross-border e-commerce, causing a complete collapse and evaporating orders. The owner of a luggage company handling U.S. orders was left distressed.
做好了12000只，包到一半。
We already produced 12,000 bags. Halfway through packing, halfway through quality inspection, now we're wondering if we should even load them into containers. The American brand just informed us they no longer want the shipment. Warehouse number 3 has 40,000 bags piled up. We recently shipped out 20,000 bags. They reached Shenzhen's Shekou port, but unbelievably, they had to be sent back again. Now they're back in storage.
Tariffs on Chinese products have been raised by countries around the world, leaving China's manufacturing industry with limited options. As one industry insider said in a video,
美国上调关税，然后这个欧洲上调关税。
The US raised tariffs, then Europe, and then Japan and South Korea raised tariffs. Russia, Vietnam, and then even Africa countries have raised tariffs. China's manufacturing is caught in unprecedented difficulty, almost at its darkest hour. We just imposed tariff on South American beef and they immediately retaliated. Facing this kind of situation, how can we possibly hold on? Where's the way out? Where's the hope? China's manufacturing supply chain is secretly being moved out. According to Freightos data, the cost of a 40-foot container shipping from China to the US dropped by 27%, while the price for a similar container from Vietnam to the US increased by 15%. The reason is clear. US imports from China dropped by 64% in March, while imports from Vietnam increased by 23%, and Mexico saw an 15% increase. Shipping giants like Maersk and Hapag-Lloyd have already started to scale back their reliance on China. Maersk launched a Vietnam-Mexico fast route shipping electronic component from Dongguan to Vietnam, labeling them as Vietnam tag, and then shipping them to Mexico for assembly and finally sending them to the US market. Aboard 7 empty containers are stacked high, and drivers sit on the ground looking at their phones. It's clear they're not waiting for goods, but rather for the day when China's manufacturing might be phased out. The rise of Vietnam, Mexico, and Thailand, the global reshaping of supply chains. As the US-China trade war continues to escalate, more and more Chinese factories are facing the harsh reality. Staying in China means losing market competitiveness. Moving to other countries means abandoning years of production infrastructure built in China. However, driven by economic incentives, more factories are choosing the latter. A factory owner in Dongguan who runs electronic business openly said in a video,
咱们工厂接了大量的这个外贸的订单。
Our factory has received a large number of foreign orders. Starting next year, we're preparing to move our factory to Vietnam. We'll shift some of our production lines to Vietnam and start production there. Tariffs on foreign trade here in China keep going up, and I know many factory owners have already started moving to Vietnam.
Another factory owner from Dongguan admitted in an interview, "We used to be the center of global manufacturing, but now US clients are explicitly asking us to shift to Vietnam for a cooperation, as their production efficiency is now on par with China's." In addition to Vietnam, Mexico is also becoming an important link in the global supply chain. With its geographically proximity to the US and the support of the North American Free Trade Agreement, NAFTA, Mexico has become the top destination for US companies relocating production lines. Data shows that imports from Mexico to the US have increased by 15%, and this growth trend continues. One business calculated that after a 25% tariff was imposed on Chinese electric bikes, importing the same bike frames from Cambodia and assembling them in Mexico actually lowered the total cost by 8%. This puzzle-style production model is becoming a new strategy for multinational companies to avoid trade barriers. A supply chain manager from a multinational company revealed, "We're having meetings every day trying to figure out how to split Chinese manufacturing into 3 different countries. This is not only to avoid tariffs, but also to diversify risk and improve the resilience and security of our supply chain." Shipping companies are also adapting to this puzzle-style production model. Some companies have started splitting their shipping routes to the US into multiple stages. First, shipping to Vietnam to load half of the cargo, then to Thailand to fill the containers, and then finally heading to the US. This complex route arrangement is a direct reflection of the global supply chain reshaping. The survival crisis of Chinese factories and the CCP's inability to respond. The tariff storm has quickly spread throughout China's manufacturing sector. According to data from China's National Bureau of Statistics and the China Federation of Logistics and Purchasing, the Manufacturing Purchasing Managers Index, PMI, fell to 49 in April 2025, the lowest in 16 months, well below the expected 49.8. The Caixin and S&P PMI also dropped sharply from 51.2 in March to 50.4, nearing contraction. A factory owner in Zhejiang who has run a textile factory for 15 years looked around at the empty workshops, his eyes full of confusion. "If this continues, we won't even be able to pay our electricity bills." His factory once had 120 workers, now has just 38, and they are on rotating shifts. Orders have dropped by 68%, but fixed costs have remained almost unchanged. The struggle of small and medium-sized businesses is spreading across the country, while the Chinese government's response seems inadequate. Macroeconomists have analyzed that the sharp drop in PMI reflects a drastic decline in external demand, which has had a devastating impact on China's export-driven economy. The Caixin think tank further noted that in April, both supply and demand in the manufacturing sector slowed. Export orders sharply decreased, business accelerated inventory clearance, and logistic delays became frequent. Market confidence has hit rock bottom. This year, the Chinese government has introduced a series of so-called foreign trade stabilization policies, raising export tax rebates, increasing trade financing support, and building foreign trade transformation bases. However, these policies do not solve the core problem for China's manufacturing industry, which has already lost international trust. As an industry insider with 30 years of experience in foreign trade pointed out, these policies are just temporary relief by handing out money to businesses. The core issue isn't money. The key is that foreigners no longer trust China. No matter how much the government spends, it can't buy back the confidence of international buyers. In Kunshan, Jiangsu, several Taiwan-funded electronic factories experienced a more dramatic scene. Local government officials sent a special team to visit the factories, offering tax incentives in an attempt to persuade businesses not to withdraw their investments. However, the day after the visit, these companies quietly began transferring equipment to Vietnam and India. A Taiwanese businessman who wished to remain anonymous said, "When the government leaders came, We smiled and nodded, but who would put their eggs in a basket that's already starting to crack? A director of a foreign trade association in Shenzhen privately admitted the official export data and what we see at the ports are two completely different worlds. The data says exports dropped by 8%, but in reality, most of our members' companies' orders have been cut by more than 40%. An internal survey in Guangdong revealed that in the first quarter of this year, nearly 200,000 foreign trade-related jobs disappeared in Dongguan alone, and this number is expected to worsen in the second quarter. Without immediate support for the export manufacturing sector, the current wave of shutdowns may rapidly lead to increased unemployment. The impact of the tariff conflict has indeed exceeded initial forecasts. China's Ministry of Commerce recently announced its commitment to supporting high-quality development in cross-border e-commerce. However, the feasibility of this statement is now in question. As early as 2024, companies like Temu and Shein started building logistics centers in the United States. They hoped local warehousing could help avoid tariffs, yet a report from Citibank pointed out that Temu's US warehousing projects covers only 10% of its business, insufficient to counter tariff impacts. Data from the US Department of Commerce shows that 85% of Chinese cross-border e-commerce goods are priced below $50 each. Switching to local warehousing would double the cost, making this approach impractical. The impact of the US-China trade war extends beyond bilateral trade, reshaping global economic patterns and industry structures. Companies now increasingly consider political stability and aligned values when selecting new locations. A senior executive at a major American semiconductor company stated in an internal meeting, when evaluating suppliers, we no longer focus solely on price and quality. We also assess political risk in their countries. We rather pay 20% more to avoid risking another supply chain disruption. Multinational corporations are now establishing redundant production bases across different regions. Southeast Asia has emerged as a hub for the electronics and light industry. Mexico is becoming a key manufacturing center serving North America, while India attracts substantial high-tech investments thanks to its large domestic market and strong software sector. A recent UBS report indicated that China's share of global export is expected to drop from 29% to below 21%. Meanwhile, the combined export share of Vietnam, Mexico, and India will rise from 12% to 19%. World Trade Organization forecasts that while China's export to markets outside the United States may see slight growth, it will not compensate for the 77% loss in exports to the US. At the same time, countries heavily reliant on the Chinese market are adjusting their strategies. Australian mining companies, German automakers, and Japanese electronics firms are accelerating their search for alternative markets. For the United States, this trade war has evolved beyond short-term economic calculations. It has become a means to reshape the global economic order. As the U.S. Commerce Secretary stated in a closed-door meeting, the U.S. aimed not only to bring manufacturing back home, but also to build a reliable global supply network with our allies. He said that it is not isolationism, but a principled economic security strategy. With containers stacking up in ports and factory orders sharply declining, the US-China trade war has shifted from a bilateral dispute to a profound reshaping of the global economic landscape. The speed, scope, and impact of the shift has exceeded many expectations. The aftershock of this economic upheaval will likely resonate globally for years or even decades to come, presenting unprecedented challenges to Chinese manufacturing.